Hello and welcome to the Investing Master Series. My name is James Boyd. Today's date, January 13th. Happy Tuesday to you. Now, just real quick as we get started, I normally teach at this time, so this is live right now. If you're watching this on recording, we invite you to actually continue to watch those recordings and also attend live. Also, remember, I'll show you a playlist to this class in just a moment. We also have Michael Fairborn with us in the chat. You know Michael Fairborn. Say hello, Mike Fairborn. And also, just real quick, now, by the way, I just want to say, Mike Fairborn, he's literally my best friend. I have two best friends, but Mike Fairborn, he is my current best friend. And I always joke with him, as long as you don't make me make you pay like a monthly fee to be your friend, that'd be great. All right, a little fun there. Now, we also got many of you. David, hello to you. Richard, Sandy, SIPC 5201, BJ, and many others. Welcome to all. Pia, hello. George, and many others. Welcome. Now, just real quick, want to go into what we're going to discuss. So we have been really working our way through the series of different strategies an investor might consider. We talked about on 1218, 1222. Really think of this as stock trading, right? That is the foundational concept. With that, we talked about cover calls, married puts. Those actually bled then into callers. That was just kind of building up to callers. Short puts or cash secured puts, short put verticals, which is piggybacking on short puts, long synthetics, which is really piggybacking on trend trading and swing trading. And this long call verticals is very reminiscent of short put verticals, but just has some differences to it. Instead of puts, we're talking about calls. Instead of actually probability, we're probability of short put verticals. We're talking about profitability, okay? And we'll see that here in just a sec. Now, if you said, I actually don't know where we could actually find those classes, super quick, we're going to go to schwab.com's website. We're going to go to Learn. Now, if we go to schwab.com, just go to Learn. We haven't even logged in. We actually go right here to where it says Schwab Coaching, right there. And now what you're going to see is when we pull that up there, we're going to go to Live Webcasts and Virtual Workshops. So this is functionality you want to know. If I click on that, you're going to see that there's a schedule here. You can isolate who you're looking for, okay? Now, if I went over here to the right-hand side and said coaches, James Boyd, or any coach, but in this case, let's say James Boyd. If I clicked on that, you're going to see that it's going to show the prior classes, okay? And you're going to see that those classes that line up, 29th, okay? You're going to see where we actually talked about on the 29th, married puts, callers, right? We actually got into starting to invest in 26th, the 5th. What was on the 5th? We didn't have a class on that day. We also talked about, as far as the topics, short puts we actually talked about, right? Short put verticals, right? Yesterday was long synthetics, leveraging a trend, and here we are here. So just make sure, if you said, how do I go back? Go back to the December right there, click, and you could see where we went all the way back to ground zero, okay? Swing trade, there's trend trade, reach out and grab them, bookmark them, make them into a playlist, they're yours, okay? Every year we're going to do this at the beginning of the year, and then we're going to spend the rest of the year focusing on applying the strategies and kind of working on some of those fine knit details. Now, as we hop in, remember that with what we discuss, as we talk about options, options carry a high level of risk and are not suitable for all investors. Also understand when we talk about the information, it's done for general informational purposes only. When we talk about the examples, we will do those in the Paper Money software application right around December 20th or so. We reset the 2 Paper Money accounts to practice, okay? And also understand that's done for educational purposes, and we're going to try to just learn the strategy and see some of the details in action. Also understand that investing involves risk, including loss of principal. By understanding this risk, it might help you identify what strategy you might consider for yourself, okay? And also remember, when we talk about short options, those can be assigned at any time, up to expiration, regardless of the in-the-money amount. And also, if we talk about examples today, which we will, just know that I'd like you to practice on Paper Money alongside of us. That way you could actually follow along in class. Now, let's go ahead right here and just hop right in. I want to kind of talk about the market just briefly. Okay, so if we're talking about the S&P 500, before we look at the sample plan, kind of holding here down, whopping 0.2%. Not a whole lot of action there, at least for the S&P. If we're talking about, let's say, the Dow Jones itself, down 286. That was that. So both of these were brand new highs yesterday, just kind of down about 0.5%. Is there any Dow stock that's dragging that down? I thought it was kind of worthwhile to kind of bring up. You're going to see that when you look at the number of stocks trading above their 200 period moving averages, that's a recent high. And if you actually look at the number of stocks that are actually trading above their 50 period moving average, that's also been making some highs as well. Now, you better sure hope so, because the S&P was at a brand new high. What about the small caps? Well, those small caps, I got to say it, doink, okay, sorry, to a brand new high. Now, remember, I never want someone to actually think we're haters of small cap. I've never said that, okay? I just, when we're talking about, let's say, stocks with bigger income statements and balance sheets, clearly the other ones are there, like Dow stocks, S&P stocks, NASDAQ stocks. But the smaller caps, to me, are kind of more of a sentiment reading on market willingness to take risk. If this chart is going up, I might not be taking risk, but somebody else is. Now, NASDAQ itself, you pull this up, we haven't seen the breakout. Well, okay, it broke out, but we haven't seen the key word is thrust to the upside. Not yet. However, semiconductors, we also see that those hit a brand new high here today. Do not forget about the memory chips. A lot of people say, well, hey, we don't have a proxy for memory chips. I would still look at SOX, but as we're asking this question, what are some of those memory chips that have also gotten a pretty big push? Now, we would chuckle if someone said, yeah, silver is too high. Silver is too high, can't go up any higher. Well, there she is, 10% in the last 2 days. Again, that same person will say money doesn't buy happiness. That might not be true. Personal peace, maybe not. But happiness, maybe, okay? Now, if you take a look at, let's say, gold itself, just kind of rounding this out, it's also up to a brand new high. Again, pretty interesting. Energy is something I want to kind of point out just real quick, going to a short-term high. And as we talk about these long call verticals, this is now really applicable. So when I first got started investing, I think the Dow was like at 6,000, 6,500. Back then, almost close to the Vietnam War. I mean, it was a couple years different, but it was close. We didn't talk a lot about long call verticals because many of the things that we looked at were lower price. The problem actually becomes when you actually get, let's say, indexes or sectors at these highs and making higher highs. I mean, going up, the individual stock prices become higher. And that is a foundational concept to understanding maybe long call verticals could be an avenue. Now, also, if we look at industrials, meow. And if we look at staples, nice little push through the channel there. You're going to see utilities, not so much. Basic materials, where are you at? Brand new high with like a wider candle. But overall, there's kind of some movement there. Now, let's kind of talk about just real quick. So the points I just made mention of is as the index actually goes up higher, some of these stocks could become a lot more expensive. And the investor says, geez, I like to get in, but geez, how many shares can I really buy? Well, there's different strategies for that, okay? Now, remember we kind of said we're using Excel. You don't have to be an Excel guru, okay? All we're doing is using it as a sheet of paper. So just fear down, okay? This first page, we're just kind of talking about some of the strategies. And we're going to kind of add right here this long call vertical. The goal, the vision of what we're really creating is that you would have a page like this, a summary of what are your stated goals that you're focusing on. Hard to hit something you can't see, and neither have you planned for. The second thing is, what strategies are you trying to focus on? So we were trying to treat this like a business where there's strategy and really routines in place of what we're trying to execute. Now, remember on this bottom piece, I can click on the bottom here, and this now just takes us to different pages. So if I go to the sheet 8 right here, I'm just going to put in here, if you don't mind, long call vertical. And so each one of these tabs represents a strategy that we're trying to execute. Now, quick heads up, and I said in chat, So next Thursday, the 22nd, we're going to actually create kind of a page where we talk about, how do you know maybe some questions you might ask of when to consider a strategy more than others. That will be next Thursday. Okay. And why not Tuesday? I'm off on Tuesday. I'm off next Friday. So I'm having to take next Thursday. We'll do that. Now, let's kind of talk about this long call vertical. Okay. Now, long call vertical. Okay. Now, my first experience with the long call, that was my first trade I ever did. I bought the Qs. Okay. Man, I'm going to tell you right now, I didn't mind the fact that what I paid for it, but I didn't like the fact of time decay. Okay. There's some people that just don't like paying for time decay. We like the unlimited upside to define risk, but we just also don't like, we pay for it and the stock actually has to go up. So if we pick a long call strike and we pay for it, so when I say pay for it, we're really saying it's a debit. And so if we buy it, let's say the long call at 100, and let's say we pay $350 for it, we would actually need a break even at 103.50. Type in the chat, are you with me? I'm going to tell you right now, I feel really bad. I personally do feel bad. I'm a teacher. I care about people. I try to really lay it on the line. But if people are not here and listening to this, I feel bad for them. Why? Well, because it leads me to believe, probably with good cause, that they don't have a strategy that they feel comfortable in executing and trying to ride those trends, whether they're swing trades or intermediate trades, okay? Now, but we're going to try to fill the gap in. Now, the biggest actually thing is when we look at this is I didn't like that fact. Long call by itself. So that long call by itself is delta positive. And what does that delta positive actually mean? That actually means it's a bullish strategy. So let's start with something we know, right? It is also theta negative, meaning every day that you go by, remember that pail we talked about? Every day that we hold the pail, the long call, it's just dripping, dripping, dripping out. The positive about that is it's actually Vega positive, meaning if volatility were to go up, the option price should go up, helping that long call. So there's parts of it we actually like, but if we said long call vertical, okay, long call vertical, we're on both sides. We got a long call, which we just talked about, which is the foundational concept, but what we're doing is we're doing a short call. So when you sandwich these two together, what it really does is it really becomes more theta neutral. It really becomes more Vega neutral. And what it really does is it creates a delta less bullish than a long call. Okay? It becomes less bullish. Now, but it's still bullish. Okay? Now this could actually be done whether it's a stock, it's an ETF, check, liquidity. Since we're on both sides, a long call and a short call, we would like to actually see things where the option spreads, okay, narrower than 20 cents. Okay? Now, the one thing I do want to bring up here just real quick is when we talked about the concept, the short put vertical, that was really more of a trade about probability. The stock did not have to go up typically to break even. And so you got less credit for a higher probability. Now, there's reasons why an investor might choose a short put vertical. I do not want to tease you. Stay tuned for next week on Thursday. Okay. Now, the biggest thing is if you said, look, I want to do like a long call vertical. So when we say that probability, we're probably actually saying, look, this might have higher IV. Why? Bigger premium. Why? Okay. What does that actually lead to? Lower break even. Well, in this case, that long call vertical, it's not as much, it is some about probability, but it's really more about profitability, okay? And we could actually have low, medium, or high IV, okay? Now, I didn't like to tease anyone. I usually am not a teaser like that, okay? Now, what this actually does is this actually creates a higher break even. So if you have, let's say, a greater chance to benefit, can have a lower break even and have to have a higher break even. Now, let's look at our first example here for just a second. Now, when we do this trade, when we talk about trend type, well, trend 2, trend 3, trend 4. Trend 2 is when the stock is above the 10 but not the 30. Trend reversal, in other words. Trend 3, we should all know by now. My gosh, where have you been? Okay, the stock is above both moving averages, the 10 and the 30. Trend 4 is when the stock is above both moving averages, but up near an area of resistance. Now, the thing about that is, if you buy or you do any bullish position in trend 4, you are clearly thinking that that stock might be in a continuation pattern. Do they all continue to the upside? No, that's the risk. So what you're going to find is people that tend to be more successful, they're putting on positions in trend 1, 2, 3. If you are putting on your positions and waiting until 4, well, I probably don't have to say this, but you probably struggled, okay? And how do I know that? Because that's what I did, okay? I would wait until there was confirmation and confirmation until things have gone up so much where they're starting to become more profit-taking. As soon as I got in, things started to pull back, okay? And I said to myself, if I did the exact opposite of what I did, I would have been profitable. I'm going to repeat what I just said. Go back. If I did the exact opposite of what I did, I would have been profitable in the shorter term, okay? Now, what does that really mean? Was I led by technical analysis or was I led by emotion? Emotion, okay? Now, let's kind of talk about this. So when we take a look at this, when we talk about the stock, okay, vol, and when I say this, I'm going to say 1 million plus stock average volume. We already said right here when we talk about option spreads narrower than 20 cents, okay? You got to remember something we also did make mention is it doesn't really matter on this is where we could look for a low, medium, high IV, all the above. The biggest thing is if we said, why would we choose a long call vertical, okay, if we ran into a stock that was probably higher than $200 plus, we would probably be thinking about a short put vertical or a long call vertical from the standpoint is that it's going to chew up the capital quite quickly. Have you ever realized how quick it can be to go through $50,000 in 5 minutes? You realize that, right? We went out there and bought 100 shares of Apple. There's 25 grand right there. 100 shares of Amazon. There's another 25 grand. We only did 2 trades. So when you start getting stocks above 200, this is where verticals might be really looked at. Now, the biggest actually thing is let's kind of talk about when we talk about the expiration, okay? We're going to focus on that 20 to 50 days to expiration, not longer. 20 to 50 days to expiration. We're picking one strike in the money, okay? And that's probably going to get us a delta of about 55 delta-ish. And we're going to selling one strike out of the money, okay? We need to verify liquidity. When I say verifying liquidity, option spread, volume, and I'm talking about option volume, okay? Volume is today, and we're going to double check the open interest. Okay, let's go to work now, okay? Now, I need to run a search. Well, let me tell you what my search is right now. I'm just going to look at the Dow stocks, okay? Now, if I look at the Dow stocks, I'm going to come back to, let's say, one of them. Now, remember, if industrials are hitting a brand new high, it would not be unthinkable to think that maybe Kitty Cat, meow, is actually punching to a new high. Now, this is, if you look at the pattern, calling all technicians here. What type of pattern was this? Well, you kind of see on this, you kind of run down, a little run to the upside, a little run back. And we have said so many times, okay? I feel bad for my children, okay? Because I've told them 100 times, and my daughter is here. She probably bust through the door and say, trust me, he will tell you again. Okay. Now, here's the deal. If you take a look at this, you get a lower high, and that lower high turned into a higher low. Okay. Classic bounce. The investor that doesn't maybe quite understand as much yet, they'll overanalyze that one red candle. But remember, if you listen to what I said, if that pullback is less than 3 days and those investors start buying it, doink, 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 right there. It's not as bullish not as bearish as what you thought, else they wouldn't have only waited a day to buy it again. And if they're buying it below the moving averages, what does that tell us? It's more bullish than you think it is, okay? Now, what I want to do is I want to use this Caterpillar. Here it is, a $641 stock. Now, if we said what type of pattern is this, kind of also has like a cup pattern. The base of this cup is kind of like right there, a little run to the upside. There's kind of the cup, okay? And there's a little yank down, a little fleek. And what you're now going to notice is you kind of have like a little push there. Now, could verticals be done right around earnings time? Yeah, sure, okay? So remember, you're on both sides. So if that volatility has gone up, you pay more for the call, but you collect more for the short call. Now, what we're going to do is we're going to go look and see, can we pick something with 20 to 50 days to expiration where we're going one strike in the money? Now, I said, hey, look, if we pick one strike in the money, it's probably going to have right around a 55-ish delta. We're at 54. Now, the one thing that you're going to notice when I'm doing this at first, okay, what you need to notice here is if we go higher and higher and higher, the option prices are probably going to get wider apart. Noted. What does that mean? It's probably going to be harder to get in and out if you're trying to do this in a day trade. Now, when I say day trade, I'm saying, let's say you're trying to get in today, but maybe out tomorrow. In today, maybe out 2 days from now. So I should really say days trade, okay? Because you need really the movement in the stock to overcome the spread. Days trade, okay? But what I'm going to do is I'm going to show you this, and I'm going to show you some variance here so we can learn. Now, what I'm going to do is I'm going to right-click on the ask price. I'm going to then go to vertical, and I'm going to actually show we're buying one strike in the money, and then we're selling one strike out of the money. So the difference between those strikes is $10. Max loss, or the spread width, I should say, is $10. To get into this trade, there's the debit. Like a debit card meaning you pay. What in this case we see is it's $4.68. Why do we care? Well, because we have a right to buy those shares at $6.40. We're paying $4.68, confirm and send, and now that's going to really give us, in this case, the break even. That's the break even as of expiration. We see the difference there between the, got a $10 spread, less the debit, it gives us the max profit, the max loss, $4.68. So in most examples, we're going to see in this case that whatever the reward is and the risk is, max profit, max loss, it's about 1-to-1. Okay? Now, many investors that's why I call this a profitability trade. Profitability trade. So some people look at a short put vertical and said, I would never do that because you're not making as much as what you're risking. Okay? Noted. But that's a probability trade. And this is going to be a trade where it's more 1-to-1. Now, notice right here, we're going to see that we have a commission there. We're buying the call and selling the call, hence $1.30. Now, what I'm going to do in this case, let's just bring it up where we can see this right on the risk profile of what it looks like on the graph just real quick. We're going to right click on this line. We're going to analyze that trade. And when we do this, we're going to go risk profile. Here it is. Now, when we talked about short put verticals before, when we actually also talked about, let's say, callers before, this graph, you should say, this is now the third time I've seen it. That's true. If you're paying attention, you're like, this graph looks very familiar to what we talked about last time. That's true. Max loss built in. So we can go to sleep knowing that if the stock went to zero, we got a right to sell. Okay? Or do we have the right to sell? No, you just want to make sure you're paying attention. Well, no, there's a built-in maximum loss. That's what we should say. Oh, he tried to trick me. That's right. Just make sure you're on your toes. So now what you're going to notice is there's the cap. Now, I know how a lot of us feel. I don't like a cap. I don't like a cap. Then why are you working a job? You realize that? A job where you don't have a bonus or anything like that, there's a cap. Okay? So sometimes a cap isn't all bad, but there's a trade-off. Welcome to life. Okay? Now, here's the deal. So we could actually see, I want to bring up the Greeks. Now, one of the major reasons why some people like verticals is they like the lower delta. Now, I remember when I first got started in the stock market, man, these stocks I was looking at, they would just go all over the place. And what happened is as it went all over the place, my emotions went all over the place. Well, because I was doing stock trading. And if you do stock trading, your delta is 1 or 100 if you did 100 shares. When you do a vertical, long call vertical or short put vertical, the delta is not 1 or 100. It's, in this case, 5. So if that stock went down $1, $2, $3, $4, $5, etc., for every $1 we go down, we're down about $5, down $10 per contract, down $15, down, now that's not $1,500, this is $15-ish, down $20, down 25. So one of the reasons why some people like the verticals is they can handle volatility. This is major because what happens when the stock is swinging around, if we pick a strategy that is too bullish, you actually walk right into the trap of your emotions playing games on your mind. When the emotions play games on your mind, you start moving your mouse and you start clicking on the button to sell, and the trend is not even over. How do you know that? Okay? How do I know? Maybe I learned something. Okay? We do that. We're people. We're not robots. Okay? So the biggest actually thing is here, when we go back, when we position size, we're going to say, look, how much could we risk on a one trade basis? Okay? Let's say we could actually risk $750. And when we said on a one contract basis, it's 473. So how many contracts could we do? The answer is 1. Okay? Now, what I want to do now is I want to take one more, and then I want to talk about once we have the positions on. Okay? So I'm going to go Caterpillar. What I'm going to do in this case is I'm going to right click, okay, in the paper money account, buy custom with OCO, buy vertical. And if I do that, there it is. And notice we're trying to get the mid price. We're not trying to say the natural, the 705. Does that mean it's going to get filled? Well, we might have to see. Okay, we're going to have to verify. The wider the spread, the harder the fill might be. Liquidity is not always the same. If you don't understand that concept, go to the local grocery store and just watch how at different points of the day, the grocery store is more busy. Liquidity changes throughout the day, just like in the stock market. Now, if we take a look at this, there's that trade. Now, this trade was an example of something where the implied volatility was 38. Now, remember, if that implied volatility is higher, the option spreads might be higher. Noted. But James, wonder if we were to look at something maybe a little bit less volatile. Does that influence the spreads? Well, let's go to Chevron for just a second, okay? Now, Chevron, what you're now going to notice is I'm going to do two trades very fast so we can see differences. What you're now going to notice is if we went down to Chevron with 38 days remaining, the IV is 26. Well, what do you notice about the spreads? They're tighter. They're 10 cents apart. Now, if we go look at right click on that 165, we actually go buy, we go right to where it says vertical. We look at this, it's a $5 wide spread. And what's nice about a $5 wide spread? Well, you can maybe customize. You might do one contract, you could do two contracts, just kind of more strikes. Do we have to go the 165 and then 170? No, we can change it if we wanted to, okay? Now, when we look at these numbers, it's a $5 wide spread, but the numbers don't really change that much. The max profit, $295. The max loss, $205. So in this case, I wouldn't expect this always. The max profit is going to be what typically the max loss is. So now what you're going to see is the break even, 167.05. Okay. And now what you're going to see noted here is we're going to go ahead and send this order. Now I want to do 3 different examples of bullish trades, and that's not as low as I want. Let me use Walmart. Yeah, gosh dang it, that's not as low as I want. But let's use Walmart. No, let's go back to Johnson & Johnson. I was trying to pick something that had a little bit lower volatility, but I'm not being very good. So we did Caterpillar. We also did Chevron, and let's take a healthcare stock, Big Johnson. Johnson & Johnson, that is. Now, Johnson & Johnson, when we talk about any bullish trades, of course, we would talk about things like bounces, breakouts, and crossovers. Like I said yesterday, if you have a breakout, can that be a crossover? Yes. If it breaks out, could that breakout be a crossover and a bounce? Yes. Just say yes. So they're not necessarily all different. They're just they look different, but they're really showing almost the same thing. Now let's put this trade in. Let's talk about once we put the trades on management during the trade and the expiration. We're going to right click on that 210 there, vertical here. And now what we're going to see is the 210, 220, 475. Wait, that's 10 points wide. Debit 475. This is kind of more your classic, 1-to-1 max gain, max loss. Now, what I want to do is we're going to go ahead and send that trade. So we did Caterpillar, we did Chevron, and we did Johnson & Johnson. Okay, send it. Now what I want to do is I want to kind of go back and just real quick, I want to draw, okay, kind of some of the things. So when we talk about, okay, let's imagine the investor said, look, I got into the position. I'm in. Okay, there. Let me just go back. There we go. Let me get a little thicker. That should work. Okay. Now let's kind of talk about this. There's no difference if we're talking about, let's say, percentage gain. Too big. Okay, so let's go back. So when we talk about percentage gain, now you should already know where I'm talking about, and this is not where I want to spend the time. Percentage gain. Okay. Percentage of the max gain. We said before, first 10 days. You already know what I'm going to say. 50%. If you get 50% in the first 10 days, exit or roll. You exit, you're actually thinking the move's done. If you actually say, look, I'm going to roll, you think actually there could be more to that movement. Technically, if we're saying 20 days to expiration or more, 20 days to expiration, you're looking for 65% plus. So this first one is the first 10 trading days. Okay. Did you get 50%? The investor might exit or roll. If there's 20 days to expiration and there's 65% plus, exit or roll, the investor might consider. And we're actually saying this is 80% ever. Okay. 80% ever. Okay. Did you actually get that? And the investor might say, I'm going to exit or roll. The only way we get 100% is it goes way up in our direction. But you're probably still not going to get 100%. You can get close. The only way you get 100% is you go all the way to expiration, typically. Now, I want to now talk about the 4 to 10 days to expiration. Okay? Now, this is very important we actually talk about this because there is the difference between these and stocks is there's expiration. Now, I want to imagine in this case that we did the 100 and the 105. Okay? So we bought the 100 and we sold the 105 call spread. Now, I'm going to say that, for example, the stock at 4 to 10 days to expiration is at 107, and let's say we had a 101 break even. Okay? What happens in that scenario? Where are we within 4 to 10 days to expiration? Well, the thing is, if we had 4 to 10 days to expiration and the stock is at 107, there's probably a pretty good chance if the stock was above both strikes, we probably have a decent percent of the maximum gain. Okay, so we probably have a high percent of max gain, MG. In that case, we could actually exit or roll the position. If we wait all the way to expiration, there's risk of it falling back and ending up between the strikes or even below the strikes. Clearly, this is what the investor wants. They want the stock to be above both strikes. Now let's change this up. Stock's at 100. Okay. So, well, I want to actually see if I can't grab something just real quick. Okay. So let's say in this case, let's see if we can't do this. Okay, there we go. So now the right again. Okay, now let's imagine the stock in this case is at 104. Tell me what happened. Tell me what happens now. So that stock is at 104. What does that tell us? We're in between the strikes. Okay, we still got the 101 break even. And is there a chance that we might have a portion of that max gain? Yes, but the thing is, we're in between the strikes. Okay, now, so if that stock's at 104, this is in the money. Anything that's in the money at expiration could eventually become something that is exercised or becomes shares. And we're saying with 4 to 10 days to expiration, the stock is in between the strikes. If you are saying, I don't want those shares of stock, well, you might say, I'm willing to take a portion of that percentage max gain. Exit or roll. Now, here's the deal. Are you going to be up as much as if you were above both strikes? The answer, no, you won't be up as much because you're in between the strikes. Now, if I look at this and say, well, what happens now in this case if the stock price and the break even are literally 101? This is the stock. This is the break even. What happens in that scenario? You're probably literally flat. What that actually means is you just did that whole trade and nothing really happened. No harm, no foul, but you're not above both strikes. So if we're literally at the 101 and the break even and expiration is at 101, you're flat. If you say in 4 to 10 days to expiration, I do not want the shares, I'm going to exit or roll the position, you're saying, look, I'm out of time. If we took this last one and we actually said, hey, James, we are now, for example, below, okay? We're now below. The way we lose, so if that stock was at 99 and the break even is at 101, that's the break even. We have a partial max loss, 4 to 10 days expiration, okay? But all of a sudden, if this actually now, let's say, drops, we're talking about it goes down to 99. Wonder if it actually goes down to, let's say, 95. You're at a bigger and bigger loss of the maximum loss, okay? And now let's take this over to expiration. If we said we let it go to expiration, well, it doesn't matter. If this stock is below both strikes, the 100 and the 105, this would be full max loss, ML, full max loss, okay? Now, what you're going to see is, in this case, if we went up just a notch, what happens if we let the stock expire at the long call expire, and the stock is at 101? Well, the 105, it actually becomes worthless, okay? It drops off. But the problem is the 105 call. What happens to the 105 call if you do not get rid of it by trying to sell it? Well, this could actually morph into stock. That is why you're trying to make a decision ahead of time. Now, what you're now going to notice is, if I said, well, is it any different right above us? The answer, it's not different. If we let that stock, for example, close at, let's say, 104, the 105, that expires worthless, or should. And the 105 call, it actually could now become into shares of stock. Now, here's the deal. Is that horrible? Well, you might say, no, James, I actually want the shares of stock. Okay, well, that's your decision now. Do you want those shares? Do you want that long call to become shares? Whose right is it? It's your right, because you're the one that bought the call. Now, in this case, let's say we let this go all the way to expiration. Okay, what happens with this? Really, this if we let this expire, they both expire. worthless. Why? Because the stock is above S, the stock is above the X, the strike. Okay? So where's kind of the risk here? Well, the risk is if you actually, the closer and closer and closer and closer and closer you get to the expiration, yes, they can expire, but the risk is they become shares, okay? And what you're now going to notice is that $100 call could actually become shares itself, okay? You also have risk, let's kind of asterisk this, risk of assignment. Now wait, risk of assignment. I don't have shares. What do you have though? Well, you don't have shares. You have the long call. The long call can be exercised for, the long call gives you the right to buy 100 shares of the stock at the strike price. And that short call, if assigned, that could actually be the shares to cover that assignment. Okay. So you could exercise that long call yourself, okay, or ask the broker to help on that, okay? But simply exercising, you just right-click on the long call and it will say exercise. If you exercise a long call, that now becomes 100 shares of stock, okay? Now, what I want to do is kind of talk through. So this page is really important. I think this left-hand side is pretty self-explanatory, okay? Where I think we kind of have to make sure we're crystal clear. Where are we trying to make the decision point? Do we want to wait till all the way to expiration? Probably not, okay? So we're really kind of focusing on this 4 to 10 days expiration. So what I think about in my mind is it's like the Monday of the expiration week. And the biggest thing that goes through our mind is, do we want the shares? And if we don't want the shares, then our goal is we're trying to exit or roll on probably the Monday of the expiration week. Okay? Now, Harry actually says, at expiration, can you be assigned in the minutes after the market closes? As far as I have seen and know of, I'm going to say yes to that. Okay? Until everything closes. Now, sometimes stocks will trade for an hour, minutes, hours, an hour, hours after the Friday close, okay? So that's why when you wait to expiration, that stock is not necessarily really closed and probably until like, I'd say 3-4 hours on Friday afternoon to verify where did it close. If you said, I don't want to be in that situation, that's why we're focusing on not going to expiration, making the decision really in the week of expiration. Most investors might say, look, by Monday or Tuesday of the week of expiration, I'm making the decision, okay? So want to answer that. Yeah, Paul actually says 15 minutes after, I think it really goes back to, it's like, where does the stock actually close? And it could be longer than 15 minutes that I've seen that those stocks actually stop trading, especially if you're trading the bigger ones, okay? Now, the biggest actually thing is from Josh Pink is, can you address when to leg into a long call vertical and buy it once? Okay. Now, so on this example, I never said anything about leg in, okay? So we just kind of said, look, we're going to buy the call and sell the call at the same time. Okay, now, if someone said, James, I have pretty decent technical analysis skills, why would I buy the call itself? First, by itself. Well, maybe you're kind of right at a beautiful bounce spot. You actually say, look, it's fallen down to support, maybe a moving average. I want to buy a call, and I'm really trading a nice hold bounce. And I want to let it bounce 1, 2, 3 days to the upside and then sell the call. So why does someone do that? Well, they're just trying to maximize the gains on the call itself before selling the call, okay? Now, can you do that? Yeah, you could check the liquidity. But the biggest actually thing is if we actually did this, you could also do this as a leg in. The other way to kind of leg in is, let's say that, for example, the stock or whatever the trade is breaks out, and you buy the long call by itself, and you say, look, I want to try to get this to go up 2-3 days and then sell the call. Well, what are you trying to do? Well, you're just trying to use a long call only, get the gains on that so the gains are bigger. Why are they bigger? Because you did not sell against that call by selling the call. So I would really kind of say, if you say, look, I'm in a nice bounce spot, I got a breakout, I got a fresh crossover, you might say, look, I'm going to wait 2 to 3 days to then sell the call, but I'm going to try to get the crossover, the bounce, or the breakout the first 2-3 days and try to go for a more directional play by being long the call only. However, probably 3 days-ish later, you might say, I'm going to sell the call and turn it into a vertical, okay, and try to maximize it that way. That is something that the investor might do. You're just trying to time it, okay? Now, I'm out of my time here today. Was this helpful really going through these strategies? And I got to wrap this up. Now, remember that when we talked about this, okay, these are the things, the strategies that we want to talk about. The whole 2026, we're going to show execution of this. We'll talk about some of those little details, okay? But we kind of laid the groundwork as far as the strategies that we're going to use over the year. We're always going to reference back to these strategies and these sample plans that we actually wrote down. Now, we have Cameron May coming up next. And I also want to say thanks to Michael Fairborn for answering those questions in chat. Also, quick reminder that you can subscribe to the Trader Talks channel for free. If you have not done so already, make sure you do that. And also want to give us a quick reminder that this session has been recorded so you can go back and review it. Now, remember, with what we discussed, it was done for example, illustrative purposes only. And this has been the class on long call verticals with a focus on creating a sample plan and the Investing Master Series. Thanks again so much. And next Thursday, we'll talk about how do you pick between different strategies. Okay. And we'll do that next Thursday. With that said, stay tuned for Cameron May coming up next. Bye-bye.